clients and portfolios. Whenever using the program, I want to make sure that I have disabled any pop-up blockers. I'm going to click on Clients. Now on the bottom left, I'll click on New Client. In this screen, only the name and birth dates are going to be mandatory. In this case, I'm going to make this client 50 years old. Once I've entered some of their personal information, I'm going to click Save and create an account. Now when this window comes up, I want to click this arrow drop down. You'll see all the different types of accounts that I can create using the system. So in this case, I'm going to select a 401k. Now the three mandatory fields within this window are going to be account name, account type, and account number. Now once I've entered those fields, I want to click Portfolio Objective on the top right. Now this is going to allow me to select the client's objective for a given portfolio. In this case, I want to select growth, which is going to come with a downside risk rate of return of minus 8.5%. Okay. Now if you're unsure as to what your client's objective might be, I can click this Run Questionnaire button, which will bring up a simple series of questions. Okay, it's about 15 questions, and once I'm done answering these questions, an objective will automatically be entered for me, as well as this downside risk rate of return. Now this downside risk rate of return is letting the program know how much risk the client is willing to take within a given 12-month period. Now I can adjust this. Let's say my idea of growth is minus 10%. Okay? So you'll find that the program is very flexible in that regard. Now this downside risk rate of return will really come into play when we're running optimization. I'll remind you of that when we're in that screen. So now I want to click Save and create a portfolio. Okay, so now I want to put in the portfolio's name and its value. I'm going to make this portfolio worth $500,000. Once I've done that, I'll click Save and go to Portfolio Builder. Now the Portfolio Builder screen is pretty much the centerpiece of our application. It's where you're going to add assets into a client's portfolio, you set retirement goals, optimize the portfolio, or run reports. But first I'd like to get my client's assets in there, so I'm going to click here to add the assets. Now when adding assets, I have a couple of options. I can go through this long list of asset classes. We have over 300 asset classes within our database. I can go through this long list of funds. But if I already know what I'm looking for, like if I have a client statement in front of me, or if I know the tickers of what I want to input, I can just put in all of the tickers, just separate them by commas. Once I've got my tickers entered, I'll click Search. Now your list of securities will come up here on the left. Now once they've come up, I'm going to click Add All. When I click this button, a window is going to come up asking me to classify the securities. What that's asking me is if I want to use the returns from the actual security, whether it's a mutual fund, a stock, an annuity, or an ETF, or if I want to use the returns from the asset class, index, or sector that it belongs to. Okay, now by checking this box off, Use Common Time Horizon, I'm getting the returns from the actual security, in this case mutual funds. Now the program is going to use the longest common time horizon amongst all the assets in the portfolio. Okay. Now if I was using, if I had a security in here such as an ETF or a mutual fund that only had a couple of years of history, in that case I'd probably want to uncheck that box because the program will use the longest common time horizon, meaning if you're only going back 2 or 3 years for one security, you're only going to be going back that far for all of them. Okay, so now I'm going to click Add to Portfolio. Okay, now I'll click Update Portfolio and close. Okay, so now that I've got the securities within the portfolio, I'm going to click this plus sign to the left of Portfolio Total so that we can allocate money to our positions. So in assigning value, I've got 3 options. I go by number of shares, holding percentage, or dollar amount. Okay? Now in this case, I'm just going to go down and put some holding percentages in. So now I want to save this, so I'm going to click the second briefcase in from the left, which is save. Okay, now that I've got everything entered here, what I've got is a client's current portfolio that's worth $500,000, earning 2.56% with a standard deviation of 11.69. Now this is over this time period. It's over the last 5.5 years. Or actually, I should say 4.5 years. Okay, so now what I want to do is set some retirement goals. So I'm going to click Cash Flow and Plan Analysis. Okay. So now within this screen, you'll see here we can set our retirement goals. It says, at what age will your primary objective begin? Okay, now this case, this being a retirement account, the client wants to retire when he's 60. Let's put in 60. Number of years to complete objective. Let's say this number is 25. What that number represents is the number of withdrawals the client will be making from the portfolio, or essentially the number of years he'll be living in retirement. Now, as we go down below, let's say he wants to withdraw $40,000 a year with an inflation of 3%. Okay? Now, the client's not retired yet. He still has 10 years until retirement. So what I want to do now is click Create Additional Goals. And in this area, I can put any additional contributions or withdrawals from the portfolio. So I'm going to put here that he's making monthly contributions to the portfolio until retirement. So the type is going to be contribution. The amount, let's say, he's contributing $550 a month. It's going to be a flat $550 monthly, starting this month, ending in 10 years when the client retires. Now you'll see that it'll default here to 121. That's letting us know that over the 10 years until the client retires, he's going to make 121 deposits, the amount of $550 of the portfolio. Okay, now I'm going to click Calculate on the bottom left here. And in just a moment, or as we see now, it's going to give us our max objective withdrawal available. It's going to say, based on the portfolio's current value earning $500,000, earning 2.56%, he can withdraw $20,312 a year for 25 years. Now that's falling short of our goal by almost $20,000 a year. So what it's going to do now is it's going to give us some options to help remedy the fact that we're falling short of our client's goal. It's going to say he can make a one-time lump sum payment of this amount to the portfolio today. He can increase his monthly payments. He can increase his annual payments. Or rather than earning 2.56, he needs to at least be earning 5.93. Okay? Now, in order to calculate this, this program is using a straight line projection going forward, assuming the client is going to continue to earn 2.56% for the duration of their objective without taking into account risk. So what I want to do now is click Monte Carlo Simulation, which is going to take into account our standard deviations when projecting a probability of achieving this client's goal. Okay. So you'll see here the probability of achieving our client's goal of $40,000 is 3.2%. So not very high at all. We recommend anything above 70%. So this is falling well short of that. Now it's not only going to give us the probability of achieving our client's goal, but it's going to say he has a 76.2% chance of drawing $12,000 a year, all the way down to a 0.2% chance of drawing $62,000 a year. So now that we have this information, I can click Close up top. And now I'm going to go down here on the bottom right and click this button just to the right of our minimum rate of return required, and this is going to take us into the Efficient Frontier screen, which is going to allow us to reallocate what's currently in the client's portfolio in order to reach that target rate of return. Should be up in just a moment. Okay. Now the current portfolio we're working on is represented by a green square, which in this case has a white dot in the middle of it. Okay. Now the reason there's a white dot in the middle of it is because of the selected portfolio, which means that its holdings are represented on the right side of the screen. This light blue dot represents the optimal goal portfolio. This portfolio has the minimum rate of return while still achieving our client's goal, which in this case is to withdraw $40,000 a year for 25 years. The yellow dot represents the optimal risk portfolio. This portfolio has the highest rate of return while still staying within our client's risk tolerance level. Now this is where that objective of growth comes into play. As you see, the downside risk rate of return from before is right here. Okay? So I can use this yellow dot, use it as a barometer, letting me know how high I can go in the curve while still staying within the client's risk tolerance level. So I'm not going to go all the way up there, but I'll click somewhere between the two. You see the white dot that appears there. Now, what I want to do is compare the green square to the white dot. So by coming from here to here, I've increased my return from 2.56 to 6.68, while lowering my risk from 11.69 to 3.67. Look at the difference in the Sharpe ratio. I've increased my Sharpe ratio from 0.19 to 1.71. So I'm getting much more return for the amount of risk that I'm taking. Now if I look over to the right, it's going to show me the recommended allocation in order to get from the green square to the white dot. It's going to tell me to go from 13% to 0 in international equities, from 38% to 77.86 in domestic bonds, from 33% to 0 in domestic equities, and from 16 to 22.14 in cash. Now this is looking back over the last 5 years and how everything has performed. So over that period, bonds have, outperformed the equities here. So that's why it's recommending such a high allocation. So what I want to do is I can set some constraints, because going forward, I may not want to have 77% allocated into bonds. So let's say I want no more than, let's say in this case 45%, and then I want no more than 3% in cash. So now I'm going to click Recalc Frontier. Okay. I click back up there. So now we've gone from 2.56 to 6.40, or 48 I should say, and lowered our risk from 11.69 to 6.90. Now we've got 45% domestic bonds, 41% domestic equities, and 13.5% in cash. Okay. So now what I'm going to do is I'm going to run a Monte Carlo simulation on the reallocation of their money in order to find the probability of achieving their goal based on this reallocation of his money. Now it's not recommending anything that I don't already have in the portfolio. It's just recommending a reallocation of what's already in there. Okay, so now we're all the way up to 59%, up from 3.2% before. Okay, so now now if you look over here, we've got a 75% chance of drawing 36,000. Okay, so I think that 40,000 is looking all right, looking a lot better now with this allocation at least. So now I can click Close. Now what I want to do is I'm going to save this as a new portfolio, and then using our reports, I'm going to compare it to how the client's portfolio was originally allocated. So I'm going to click Save as a new portfolio. And when I save it as a new portfolio, I want to make the status Proposed, and I'm going to name it Optimal. I'll click Save. Okay, now once I've done that, I can click Close in the bottom right, and that's going to take me back into the financial planning screen, cash flow plan analysis. I'll click Close in the bottom right there. So now I'm back in the Portfolio Builder screen, and being that we saved that as a new portfolio, we're in that optimal portfolio as you see here. So what I want to do now is I'm going to select our current portfolio, or our client's current portfolio I should say, to compare to this portfolio. So I'm going to click this button right here. It looks like a little scale. Then I'll go Clients, Choose Sample, Choose 401k. Now we're in the optimal, so I want to select the current to compare to, so then I'll click Select. Okay, so we're in the optimal. I've selected the current to compare to. Now I want to go to Reports. Now in the report screen, I'm going to double click on Investment Proposal, which is a really nice report to use when comparing one portfolio to another. Now I'll click Build Reports. Now when comparing one portfolio to another, you always want to check this box off right here, Use Common Time Horizon, just so we're comparing like time periods, essentially comparing apples to apples. And the reports will come up in just one moment. here we are. We have our investment proposal. A little bit of disclosure. Then it shows our risk tolerance, which in this case is moderate. Our recommended allocation, which we put together within the efficient frontier. Comparing the two portfolios on the efficient frontier, showing where the client currently is and what we're recommending, earning much more return while taking less risk. As we go down, we've got the risk versus return matrix, which is essentially showing the same thing without the curve. Now as we go down, we've got the historical performance, showing over time what we're recommending is drastically outperforming where they currently are. Then we have our annualized returns graph, which is not only going to compare the portfolios to one another, but it's going to compare them to the S&P 500 and the Solomon Broadband Index, going back over the last month, year, 3, 5, 10 years, and since inception. As we continue to go down, it shows how the portfolio is allocated and how each individual security has performed over this time period. When running reports, you always want to keep in mind the time horizon that you're using. Now it's giving us the standardized average annual returns for each fund that we selected. Now we've got our risk tolerance questionnaire. Now if we would have taken the time to fill out the questionnaire that I had shown earlier, all these answers would be populated. Now we've got a portion of the investment policy statement showing the client's investment objective, their age, portfolio value, their risk tolerance, any investment constraints that we would have set in the efficient frontier, which in this case we only constrained the domestic bonds. And lastly, we've got our portfolio recommendation. Now what this is doing is comparing the two portfolios on the asset class level as well as the underlying security level and showing you any adjustments that need to be made to get from portfolio A to portfolio B. Now if you have any questions on anything we've gone over in this session or on any reports, please give us a call at 800-480-3888. My name is Ed Falstrom, and I'm at extension 103.